Good morning, Form 4. Today I'm going to introduce the General Journal, Part 1. So what journals are you familiar with? You know the CRJ, CPJ, DJ, DAJ, CJ, CAJ, PCJ, SJ, and WJ. Now I'm still going to add a further J, a GJ. Right, let's look at this example. The owner contributes 500 Rand capital to the business. You know that cash received is recorded in the CRJ. So, if we continue with this example and we say that the owner contributes a computer worth 500 Rand, where can we put this? The CRJ doesn't accommodate this transaction because no cash is involved. So, we can't put it into a creditor's journal because the owner is not a creditor. We can't put it into a DJ, the owner is not a debtor. We can't put it in a CPJ, we're not paying out any money. Neither can we put it in a salaries journal because we're not paying out a salary or we're not recording the owner as being part of our payroll. So where on earth would we put this transaction? Yes, you guessed, the General Journal. So the General Journal is there to accommodate transactions that don't go into your normal journals that you've already completed. So that is why we have a General Journal. So the same transaction, the owner contributed 500 Rand, a computer worth 500 Rand. We will increase equipment by debiting it, and we will also increase capital by crediting it. And that would be a General Journal transaction. It sounds simple enough. Let's have a look at what a General Journal looks like. Right, for a General Journal, we've got to use a General Journal voucher. If you just look at the format or the format of the General Journal, you will see that we have our normal heading, General Journal of College Stores for March 2010. In the number column, we put in our source document. The source document would be a General Journal voucher. In the D column or day column, we put the date. The month has already been established in the heading. Under details, we're going to put the account credit and the account debit. Under debit and credit, we're going to put the amount. Then you see that you also have columns for a debtor's control and a creditor's control. This is the debtor's control columns, debit, credit, will only be used for debtor's transactions, and the creditor's control will only be used when we transact with creditors. Again, it's when we transact with them, and those transactions cannot go into our normal journals. So let us look at the example that we've just done. Okay, so equipment and capital don't relate to debtors and creditors, so we won't be using these two columns. We will purely concentrate on this column called our general ledger columns, debit and credit. So we will debit equipment to show that we are increasing, and we will credit capital to show that we are increasing capital. Now if you look at equipment and capital, I haven't typed it underneath each other. Capital is being credited, so we slightly indent the account that we are crediting. So we're debiting equipment, and we write equipment sort of against the margin, but we write the account that we're crediting, which is capital, slightly away from the margin to show that we are crediting. And then lastly, we have what we call a narration. The owner contributes computer. So we are saying in this narration why we have debited equipment and why we have credited capital. a narration is telling us what the transaction is all about. So the owner contributes computer is what we call a narration. Okay, and that is the introduction to your general journal. I'm going to show you what other accounts. Let's look at other transactions that can be entered into the general journal. We have bad debts. I'll explain it in the next presentation. Withdrawals of merchandise or other items by the owner. Just like the owner contributed a computer, he can also take a computer out of the business. So where would we record that? In a general journal. When our debtors are overdue on the account, we charge them interest and we enter this into the general journal. And these are other transactions that we will be explaining in the next slide.